Welcome to another episode of Stock Talk. My name is Avin Reina and I'm an investment coach here at Sage Investors. And this is episode 64. And we're broadcasting on Periscope, and we're also broadcasting, all our episodes are also available through iTunes in podcast format. So you can check out our website and download all the episodes. So Today's kind of a special day. I posted a new blog posting on our website, sageinvestors.ca, and it's our latest review of our robo-advisor portfolio. To give you some background, if you've been following previous episodes of Stock Talk, you've been following any of the blogs I posted on my website, I've been posting quite a bit. I talk and comment quite a bit about robo-advisors. This is this new model that's came out a few years ago, this online investing model where you can go to a website and answer a whole bunch of questions, and the robo-advisor, this portal, will develop a portfolio for you of stocks and bonds, and it will invest it for you and manage it for you. And it's really taken the industry by storm. A lot of people saying it's disrupting the whole traditional way of how we manage investments, how we make investment decisions. And it's cool. It has done quite a bit. And but one of the things I've always I've been wondering, and I question about it, and I've spoken quite a bit about it, is performance. Can you make money with a robo-advisor service or using a robo-advisor type model? And anytime I ask this question to anybody in financial services, or I talk to other bloggers, or I talk to other investment specialists, I've talked to robo-advisor companies, and usually the answer you just get these blank stares, and just literally nobody wants to go there about it. People want to spend more time talking about how pretty the colors are on the company's website and how easy it is to set up an account, that you can set up an account on using your phone, and that's great. But at the end of the day, why do we invest? We invest to make money. We're not here to prop up some kind of back office out there. We're here to make money. We're here to grow our savings. So I've always been asking this question, do these companies make money? So I'm putting my hard-earned savings into this type of service. Am I going to get a return out of it? Do I have a good chance of getting a return on it? And I've asked this question so many times and wasn't getting any response. So I decided, I'm going to try to answer this question on my own. So 2 years ago, I set up an account. I picked a robo-advisor service here in my neighborhood, I guess, and I put some money down of my own. I put my own money where my mouth is, and I put some money down, and I said, okay, here you go. Now manage it. Let's see how this type of model would work. And essentially what I've been doing the last couple of years is blogging about the experience, what I've gone through, how the whole process has been, and also, more importantly, the returns that I've generated. So this past January, as we just finished January, was really crossing the 2-year anniversary of my robo-advisor portfolio. So basically, the last post I want to talk about today is just, okay, so where are we? We're 2 years into this thing. What are the results? Am I making money out of this thing, or is this just, a fly-by-night kind of operation? So let's look at today I just want to give you the highlights of my results, of my analysis, and it says if you want more detail, you can go to the website, sageinvestors.ca. I have the blog post there. You can read it up too, but I'm just giving you the quick and dirty highlights of it. So how do we do? How have we done 2 years later? The first year last year was a tough one. The portfolio lost about 2.15%. This past year, much better. It actually did really well. It didn't look good at the start of last year, but it really picked up quite well. And overall, over the past year, the portfolio is up 13.2%. If you look at it since inception, the portfolio is up almost about 9.5%. So 9.5% over 2 years. Not bad. So I'm making money. So hey, you know what? The robo-advisor portfolio is making me money. The basic portfolio that was constructed for me was 85% allocated to stocks and 15% to bonds, based on how I answered the risk profile questions by my robo-advisor. And in terms of activity, there really hasn't been over the past year. The first year there was a bit of churn because they're basically switching a lot through some investment products, through some ETFs. In the past 12 months, there really hasn't been any churn. Like the robo-advisor, the algorithm, the computer, whatever it is that's managing my money, didn't make any sell decisions. It's basically stood pat and kept the allocation fairly close. I think it's strayed away a little bit on the margins, but essentially that 85-15 allocation has pretty much stayed where it is. And so it's good, because one of the things that the whole value proposition of it is sort of this passive investing kind of aspect, where you just build your portfolio, you grow your portfolio through proper asset allocation, and you just leave it and you just let the market kind of build on top of it. And that's pretty much what's happened. So it's pretty much lived up to its name and what its intentions are. So that's kind of cool. Interesting to look at some of the allocations of it. There's 8 ETFs in my robo-advisor portfolio: US, Canadian, foreign stocks, bonds, government, corporate bonds, real estate. So there's quite a bit of diversification in the portfolio. And it's interesting, at the start of last year, every one of these asset components in my portfolio was down. It was all in the red. But there's been such a dramatic change, obviously because of the high return. For example, the US component was up almost 17% the past year. The real estate portion, which was down at 1.15% last year, is actually down only 7%. The dividend component, stock ETF, which was like down 5% last year, is actually up now 7%. And the Canadian component of it is up 5%. So it's definitely made some very positive moves, and it has. The market was pretty good last year, and so it definitely picked up. It generated a pretty healthy return. One of the rules I look at when I look at investing, with especially stocks, is over the long term, stocks tend to return between 6 to 8%. So if you're getting anything above that, that's a pretty good year. So we're up 13% last year. That's a pretty good year. So full props out to the computer here. Another important observation: fees. One of the big value proposition items for the robo-advisors is fees are much lower compared to a traditional, giving your money to a traditional portfolio manager or a mutual fund. Fees are much higher. Robo-advisors claim that their fees are much lower. So I dug into the numbers and tried to calculate what my fees were. And the cool thing with the robo-advisor service, they're pretty upfront. They're very transparent in terms of what the fee structure is. So it wasn't too hard to figure it out. So when I looked into the total fees, basically it breaks it out into 2 components. It's the fee you pay the robo-advisor and the fee you pay to own the ETFs, the MERs for it. So in terms of the fees to the robo-advisor, it came out to about 0.2%, 20 basis points. So 2.2% of my portfolio was given to was fees, and that came out to a grand total of $10.84. I basically invested $5,000 into this portfolio, and so I paid last year $10.84 to the robo-advisor. In terms of fees for the ETFs, that came out to about 0.22%. So overall, my fees were about 0.42%, which again is pretty good. It's pretty, if your fees are under 1% total, that's pretty good. And if you're under 0.5%, that's even pretty good. Now, the key thing here is I invested only $5,000. So with the service I'm using, there is no real fees on any funds up to $5,000. So my fees were much lower. But if you just took the same portfolio I had and had invested $25,000 in it, they would charge you another 0.5%. So when you factor that in, you would be paying, if I had much more money in the portfolio, I'd probably be paying closer to 1%. So it came up to 0.92%, so almost 1%. It's interesting to note that some of the MERs in the portfolio and on some of the ETFs actually fell, which was quite pleasant and positive to see. Especially some of the more actively managed kind of components in the portfolio, their MERs trickled down a little bit too. So that was kind of cool. So the question I have is, okay, great, my fees are low, but question I have is, how do these companies make money? They got $10.84 out of me. Oh my God, I don't think you can sustain a business generating $10.84 or $10-12 off a portfolio. You really need a lot of volume to really generate that type of income for these companies to really make it sustainable. So you got to wonder a little bit, how sustainable it is. Like, the margins on this type of advisory type service is got to be like razor thin. So where do they make money? So that's kind of the first thing that jumps out of my mind. It's like, great, I'm not paying any fees, but holy crap, like nobody is. And how does this company stay in business? That's one aspect of it. Other observations that I had basically over the course of the year is one is I continuously, when I set up the account, I had to talk to somebody, an advisor at the company, who would ask me some questions about my risk profile, and we'd have a conversation about the portfolio and stuff. And that was like literally day one. So that's 2 years ago. And literally since that conversation 2 years ago, I have yet to speak to a human being. I have not heard a call. I've not got a ring. I've not even got a message or a voicemail from a human being. And I'm okay with it because that's what I expected. But if you're the type of person who really wants to have a kind of a human kind of contact interface with your financial services company in terms of talking about your portfolios, you might have some angst. I can go pick up the phone and call somebody over there, and they'll be more than willing to have a conversation with me, but I have to initiate it. They're not going to follow up with me. The onus is on me. The accountability is with me to make sure that I'm okay, I'm good with it. The only types of communication I do get is related to, when the market's crapping out or something like that. I'll get the nice little keep calm email and saying, you know what, don't panic, don't do anything, don't make any sudden moves. That's the type of communication. But other than that, since I set up the account, I've yet to talk to a human being. So you need to understand that when you're working with a robo-advisor. Some have a more of an advisory component to it, and that's basically you got to shop around. The one I chose doesn't have that, and I'm cool with it. It's all good. Another thing is interesting too is, as I said, when I started this was all about trying to figure out performance. Like, do these companies make money? It's interesting. There's been a lot of resistance by these robo-advisor firms in providing performance. But now, you know what? We're starting. It seems like, I felt like I was the only one talking about it, but now we're starting to see other people ask similar questions about this type of service. And it's interesting because my robo-advisor actually started posting some results, and it was interesting that I went on their website and I saw they actually had like a chart of portfolio performance of various types of portfolios that they manage, and I was never there before. I'd never seen that in the last 2 years. I don't know when it came out, if it just came out like just recently, but it's there. And so now we actually have some substance, some tangible things to talk about in terms of performance. And what's really interesting is but there's some questions too. Now, their model that they were basing it on was a growth model consisting of an 80-20 split between stocks and bonds. Now, my portfolio is 85-15, so it's you can't compare that as a benchmark to what my portfolio is, because in just terms of how the allocation is. And actually, the cool thing about my robo-advisor is they actually broke down the 80-20. I didn't even think they'd go there. I was really stunned and pleasantly surprised to see, wow, they actually broke down the asset allocation for this model portfolio that they manage. And so that was a good thing. So that's positive to me, as a positive event, that we're starting to see these companies become a little bit more forthcoming with disclosure in terms of performance. This is all I've been asking for, because I think it's important for them. I think it'll give them much more street cred to put themselves out there, to be transparent on that, and let the market decide whether they're a good service or a bad service. If they want to offer all these wonderful fringe services around it, fine, but at the end of the day, it's got to be revolved around the performance. So that was an interesting comment. As I said, a lot of other people are starting to ask this question about performance, and it was interesting because just recently there was an article, a company in the U.S., Condor Investments or something. They did an analysis. They actually invested chunks of money in all the different U.S. robo-advisor firms and are doing what I'm doing, just tracking the returns of it. And so they published their latest report in terms of 1 year returns on these various robo-advisors. And so these are like your Betterment and your Schwab's and your Vanguard type of robo, online management services. So it was interesting because the top ranked in their analysis was the Charles Schwab one, which generated about 10% return, and the bottom one, the number 10 ranked service, was the Vanguard one, which was really surprising because Vanguard is like Vanguard and iShares are they are ETFs. You know, they dominate the ETF landscape, and Vanguard's value proposition is just rock bottom fees. They pound the table on like fees being like next to nothing. And it's interesting that the lowest cost producing ETFs out there, which are mostly like Vanguard kind of funds, didn't do as well as other ones which charge higher fees. So I found that, and I think everybody found that quite, whoa, it's like, that's pretty interesting. What's that all about? And a lot of it has to do with their asset mix. And this comes down to understanding that you have to be careful with if you're going to go out and invest with a robo-advisor firm, is not all robo-advisors invest in the same way. They all have different approaches. The Vanguard ETF, Vanguard robo-advisor fund service took a much more aggressive approach in terms of their equities, and they got burnt in a way. They were more into the foreign content compared to the other companies, which were maybe focused more domestically. So that had an impact on performance. So when you're looking at these portfolios, if you're considering looking at a robo-advisor service to manage your money, you got to look under the hood. You got to do some due diligence. Don't just assume, well, it's got a pretty website and I like the colors and all that stuff. That's noise. You really have to look under the hood and saying, what kinds of assets are these companies investing in? What are they telling their computers to buy and sell and manage? Pretty important part. So in terms of conclusions, like, we're 2 years into it. You know, I'm making money out. The portfolio's making money. Fees seem to be in check. It's making money in a good market. The market's been great, and it's, you know, I've been able to get a chunk of that out of that in terms of return. So it's great. Now, am I ready to pound the table and say, go out and look at these robo-advisors? No, I'm not, because it's only 2 years. So we've had one up year, we've had one down year. And, you know, 2 years is just not enough, like, history to really formulate a really good sound judgment. I mean, we need about a good 5 more years, a good 5 years, really, a good 5-year cycle of not just stock market going up. We want to see how these things behave in a bad market, in a stressed market. How do people going to react to their portfolios when they're going down? Because emotions, and this is, as an investment coach, I teach people a lot about how to control their emotions and manage their emotions, especially during times where the market's not going well. And so we don't know how people are going to deal, how people who own, you know, robo-advisor portfolios are going to deal with it when the market goes down. Are the robo-advisor companies going to be there to hold their hands and say, you know, everything is going to be all right when things get crappy? And we just don't know. These companies, these services have not been stress tested enough. And until we know how these services kind of behave in a tough market, it's really hard to tell. Like, right now, we know it does well when the market's going great, but if the market starts going, then we have no idea how things are gonna go there. So I'm not ready to pound the table on these services. It's a good start, and so far the experience seems to be a reasonable experience. It's been a seamless experience setting up the account, getting information about my portfolio. It's easy to get. I have a very good idea of what the portfolio is doing for me, how it's managing my money. It's very upfront and very transparent in that. It's very upfront in terms of my costs associated with it. So it's all good. It's all good so far. But again, I'm not ready to pronounce the judgment saying definitely you need to go get a robo. You need to have a computer manage your money. We need some more time to see how these things pan out. And guess what? I'm going to be doing that. So I'm going to continue, you know, letting my robo advisor manage my little pot of money there. And I'll continue to blog and comment here my observations about the whole business model and the whole service. And so, you know, stay tuned for future updates. If you have any questions about this, about robo-advisors, you want me to talk a little bit about something specific about it, give me a shout, or anything you want to talk about in terms of investing, give me a shout. You can hit me through my website, www.sageinvestors.ca, or you can hit me through Twitter. I'm on there all the time commenting, babbling about all things stocks. My handle is @SageInvestors. So, that's all I got for you today, and this has been another episode of Stock Talk here on Periscope and also through podcast via iTunes, so check it out. Subscribe, download, like, whatever you want to do, please. So far, we've been only up there a little bit, and the feedback we've been getting from the podcast has been great, so thanks. I hope there's some value for it. So that's all I got for you today. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Cheers.